Sometime between June and September, the US government could default on its debt, sending the world's largest economy over a cliff. But this nightmare scenario isn't a foregone conclusion. Even if Congress can't get its act together and raise the debt ceiling, there's 4 ways through which we can avoid a calamity. These are going to sound unbelievable, but these are serious potential solutions that just might work. I'm going to go from the least crazy to the most crazy. Okay, so the first potential solution is to have the Treasury Department prioritize payments to bondholders over everyone else. This means putting bondholders ahead of retirees and their Social Security payments, ahead of funding for the military, and ahead of all of the government's other programs and services. In this scenario, the government would only spend the amount of money it receives through taxes. Any spending beyond that would be cut. This would obviously lead to a deep recession, and the markets might still look at it like a default because even though the government's still paying bondholders, it's not paying all of the other parties to which it owes money. Additionally, Treasury Secretary Janet Yellen has said that this type of prioritization just isn't possible based on the way the Treasury Department's systems are set up. So this isn't a great solution. Which brings us to solution number 2, which might be the least messy of the 4 options. This entails having the president invoke the 14th Amendment of the Constitution. Within the 14th Amendment, there's a section that says, quote, "The validity of the debt of the United States shall not be questioned." The 14th Amendment was passed in 1866, a year after the Civil War ended. Some scholars say that this text was added to the Constitution to ensure that representatives from former Confederate states wouldn't try to weaken the United States by threatening to not pay the country's debt. Under a similar interpretation, that could mean that it's unconstitutional for the US to default on its debt today. And so the president and his Treasury Department can just ignore the debt ceiling and keep borrowing money. Next up, we have solution number 3, which is for the Treasury Department to issue extremely high coupon bonds. This one's a little esoteric if you're not familiar with bond math, but think of it like this. The US government borrows money by issuing bonds with a certain face value. Once those bonds reach maturity, whether it be 1 year, 10 years, or 30 years after the date of issuance, the holder of the bond gets the face value back. But between the period when the bond is issued and paid back, the government also pays the bondholder coupons. Usually the coupon rate is similar to the market interest rate, 3%, 4%, or 5% like it is today. So a $100 face value bond would pay $5 in coupons per year if the coupon rate is equal to the market interest rate of 5%. But the coupon rate on the bond and the market interest rate don't have to be the same. There's nothing to stop the government from offering a much higher coupon rate, 10%, 50%, 100%, or more. If it offered a 100% coupon rate, then the $100 face value bond would pay $100 in coupons per year. How much would you be willing to pay for that bond that's giving you $100 per year if market-based interest rates are 5%? You'd be willing to pay much, much more than $100. If you do the math, then a 10-year bond with a $100 face value and 100% coupon would be worth $840 today. So in this situation, the government could sell a $100 face value bond for $840. And if it offered an even higher coupon rate, it could sell the bond for even more. Now, here's the important part. Only the face value of the bond counts towards the total debt issued by the government. So by using high coupon bonds, the government can raise a lot of money while increasing the amount of debt that counts towards the debt ceiling by a much smaller amount. That's the magic of bond math. Okay, finally, we have the 4th solution, which might be the craziest one yet. It involves having the Treasury mint a $1 trillion platinum coin. I know this sounds absurd, but based on a 20-year-old law, the Treasury Department can order the U.S. Mint to create a platinum coin of any denomination. So theoretically, it could mint a $1 trillion coin, deposit it at its account at the Federal Reserve, and then spend it all without raising the debt ceiling. Now you might be thinking, printing money out of thin air, won't that cause inflation? Well, it could, but it probably won't have as big of an impact as you might think. Because remember, even with the $1 trillion coin, the government would only be spending the money that has already been authorized to spend by Congress. This is spending that would have happened anyway. It's not new spending. That being said, as the government spends its $1 trillion, there would be some changes to the composition of money within the banking system. Reserves, or money held by banks at the Federal Reserve, would increase, which could put downward pressure on interest rates, and that's not really what we want to see in the current environment where the Fed is trying to bring down inflation. That could be offset by the Fed if it sells some of the bonds on its balance sheet, right? But it gets pretty messy, and you have a situation where the Treasury Department starts to influence monetary policy, and that hurts the independence of the central bank. So the $1 trillion coin is not ideal, but it is an option. Anyway, there you have it, for really crazy and untested potential solutions that could be used to prevent a catastrophic US government default. Of course, it's better that these solutions stay untested and we get through this mess by having Congress raise the debt ceiling, just as it's done 78 other times over the past 6 decades. That's especially the case because even if these alternative solutions end up working, they will most likely be subject to legal challenges. And in the time between when they're enacted and when we have a judgment about whether they're legal, there will be a ton of uncertainty, which is going to create havoc in the financial markets and in the broader economy. So we'll be much better off if we don't have to deal with that. Hope that helps, and follow for more insights on investing and the economy.